Welcome to WealthSpecs, Empowering Trading and Investments. Today we are meeting on New Year. Wish you all a very happy New Year. May this New Year bring you fun, success and a lot of wealth also. So we are here to see yet another interesting topic today. It's 9 personal finance rules which we all must know. It's a very interesting topic and these are 9 rules fundamental for anyone. So stay till the end. This will be of immense use to all of you. Before we go further, please do like, comment, share and subscribe. We need your support. Moreover, we give all our trading and investment related updates in our Facebook page. Please do join our Facebook page. The link is given below the description. It will be of immense use to you to plan your trading and investments. Before we go into the pointers, we get a lot of customers now asking for solutions on trading and investments. But invariably, when we see the fundamentals, how far they are now financially, fundamentally comfortable, we see a lot of lacunas. Other than that, we started now identifying these 9 basic rules, one by one. We see whether these parameters are there in place, and then only we go ahead for the planning in terms of now funds and now trading, etc. Either party we go in depth into the pointers. We'll take a deep dive. What is the first rule? Rule number 72, double your money. Those days, then for example, your father would have told you around 25 years back, if I invest in FD, in a corporate FD, in 5 years time, my money will become double. Because the rate of interest was now 12%. Now it's not the case. Now it's the other way around. Now we'll see what is this doubling concept in the current days. Number of years required to double your money at a given rate. You just divide 72 by interest rate, that's the formula. Example, if you want to know how long will it take to double your money at the current, say, rate of interest. Let us take for example, it is 8% interest. Divide 72 by 8 and you get it in 9 years. At 6% rate, it will take 12 years. At 9% rate, it will take 8 years. This is the first and foremost rule. Next rule, rule number 70. What is rule number 70? Rule number 70 is nothing about inflation. Inflation is something what we normally ignore. But we can't afford to ignore when you are doing your personal finance planning. Why it is important to the Divide 70 by current inflation rate to know how fast the value of your money will get reduced to half of its present value. For example, if you are saying 5,000 rupees now, we think that say after 5 years or 10 years, the same 5,000 rupees can buy money worth 5,000. That is a wrong myth that we have. That is not the case. Value of money will come down to half. When it will come down to half, inflation rate at 7% will reduce the value of your money to half in 10 years. This is the second rule. What is the third rule? 4% rule for financial freedom. See, this is something very important for who are now planning for their retirement corpus or planning for their retirement money. The important concept, let us go into the details. How much corpus is now required? Corpus required is equal to 25 times of your estimated annual expense. This is a general rule. Example, if your annual expense after 50 years of age is say 5 lakhs and you wish to take VRS, then corpus with you required should be 1.25 crores. How do you do your asset allocation of this money? Put 50% of this into fixed income and 50% in equity. This is a general rule. Withdraw 4% every year. That is 5 lakhs every year. This rule works for 96% of time in 30-year period. We have got enough back-tested data also to substantiate this. Very important rule. Next rule, 100 minus your age rule. In the rule, what is it given? This rule is used for asset allocation. How it is done? Subtract your age from 100 to find out how much your portfolio should be allocated to equities. This is a general rule. This is a common formula what you can follow. Suppose your age is say 30. So 100 minus 30 is 70. Equity should be 70%. Debt should be 30%. But if your age is say 60 or so, 100 minus 60, 40. Equity should be 40%, debt should be 60%. However, this is not a common rule for everyone. Your asset allocation can vary. One is depending upon your risk appetite. Number 2, depending upon your financial goal. And number 3, when you have to meet the financial goal. Based on that also, your asset allocation can vary. So, individually on a one-to-one basis, when we analyze these factors, we will be in a position to guide you properly so that your personal finance plan is something tailor-made for you. Please remember this. Next rule is 10-5-3 rule. What is the 10-5-3 rule? One should have reasonable return expectations. Idhila we'll go into the pointers. We'll go into the pointers. 10% rate of returns for equity and mutual funds that we already told. 5% for debts in fixed deposit or other debt instruments. 3% in savings account. This is a general rule. But however, good funds, which we suggest you based on your financial goals, have always outperformed our expectations. That's also we need to take into consideration. Next rule. What is the next rule? 50-30-20 rule. This is about allocation of your income to expenses. Divide your income into 50% for needs, that's for groceries, rent, EMA, etc. Beyond this, 30% for your wants, that is for your desires, entertainment, vacations, etc. And 20% for your savings, that is for your equity, mutual funds, debts, FD, etc. At least try to save 20% of your income. You can definitely save more, because in many of the cases what we are seeing is when people have an EMI, home EMI, they are able to save more. So what is the background behind this? Is nothing. You have the capability to save more than 20%, but we don't do. But when we have the compulsion to save, we are able to do. So easily you can save more than 20% of your income. Next one is 3x emergency rule. What is the emergency rule? See, many people come to us for trading and investment solutions. The first and foremost thing that we see is whether they have a basic emergency fund. We go to the next step itself of finance planning. What is this emergency fund all about? At least put 3 times of your monthly income in emergency fund for emergencies such as loss of employment, medical emergency, etc. This COVID has taught us a lot of lessons. Many of the salary people took a salary cut. Business people lost their business income or even lost their business assets. For such people, this was very, very helpful, this emergency fund, what we suggested. How much it should be? 3x of your monthly income, basic thing, mandatory. In fact, one can have around 6x monthly income in liquid or near liquid assets to be on a safer side. This we can suggest you good debt funds to invest this emergency fund also that you have with you. Certain percentage you can also have in your regular savings account. Next one, going further. This is the 8-point important point. 40% EMI rule. What is this 40% EMI rule all about? Say, if you earn 50,000 per month, then you should not have EMIs more than 20,000. This rule is generally used for finance companies to provide loans. See, even the finance companies take this as a criteria to offer you loans. You can use it to manage your finances. But invariably, what we see in many of the customers is a customer might even be having one house already. He would have already paid the EMIs for that house. And since he is able to enjoy some tax benefits when he is paying a home loan EMI, he will go for a second house also without having a need for a second house. Just to enjoy the tax benefits. Don't go for a second house without a need. This is a mistake what many of our customers do. Because they think that going in for a second house is like going in for another investment. Real estate is not a good investment as long as a second house is concerned. There are better opportunities for you to save money and get better returns in very good funds, which we can suggest. In fact, I will come out with a separate video on whether to go for a real estate investment or not. On that, we'll come out with a separate video. You can use it to manage your finances. This is the last and important rule. Life insurance rule. Always have sum assured as 20% of your annual income. Go only for a term cover. Don't go for any other term cover. Don't go for any other insurance policies. The general rule is 20x annual income. Say you earn 5 lakhs annually. Year on year, you should have at least 1 crore insurance by following this rule. This is the most important factor. These 9 rules are fundamental factors to get into the next level of trading or investments or whatever. So if you have any queries related to these rules, or if you want to have a personal finance planning for yourself based on these rules, or if you want to reach your financial goals as such, we will suggest you good funds and to go for good trading solutions. Do reach us in 9176948889. Thank you so much for staying back. Bye-bye.